Investing in the stock market is already a big step, but if you're ready to make a few upgrades and make a little extra money through your investments that's more than just capital gains, it might be time to try dividend income. But what is dividend income and how does it work? In this episode, you'll learn what dividend income is and the factors to consider before you invest in a dividend income stock. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the best stocks that pay dividends regularly. So what is a dividend? A dividend is a distribution, usually in cash, paid by a company to its shareholders. The payments are met out of a company's earnings in a given year. Dividends are usually paid half-yearly, but they can also be paid annually or quarterly and are usually made on a per-share basis. For example, an investor who owns 100 shares in a company that has announced a 10p dividend would receive a payment of $10. Dividend payments can also be made on a special basis. These are essentially one-off payments where a company has, say, completed a large transaction. For example, this could be where a business has sold off a particular division and wants to return some of the money to shareholders that it's earned as a result. Stock dividends are less common than cash dividends. Instead of cash, this is where a business issues extra shares to its shareholders. For example, a company issuing a 3% stock dividend means a shareholder would receive an extra 3 shares in the business for every 100 already held. A scrip dividend, meanwhile, is where a company offers to pay a stock dividend instead of cash. The company issuing the scrip dividend then gives shareholders a choice, cash or extra shares. Why use dividends for income? The dependability of dividends is a big reason to consider dividends for income when buying stock. Not every stock must pay a dividend, but a steady, dependable dividend stream provides nice ballast to a portfolio's return. For example, Procter & Gamble, the consumer products giant, has paid a dividend every year since 1891. Procter & Gamble's stock price has not risen every year since 1891, but shareholders who owned the stock at least got paid during those down years. They weren't totally dependent on capital gains to get paid. Examples of dividend investing. Example 1. Let's say you bought 100 shares of a company for $10 each. In this hypothetical scenario, the company pays an annual dividend of 40 cents per share. That equates to 4% dividend yield. You've invested $1,000 into the company and it pays you back $40 per year. You can decide to keep the money, invest in another company, or reinvest the dividends into the same company. Certain dividend reinvestment plans will automatically reinvest dividends for you. Example 2. A steel manufacturing firm has released its quarterly results and has a net income of $250 million. The board of directors decides to pay $120 million in cash dividend and reinvest $130 million in lowering its short-term debt. This means that the firm's dividend payout ratio is dividend divided by net income, which equals $120 million divided by $250 million, which equals 48%. The board of directors declares a quarterly dividend of 95 cents per share, reaching an annualized dividend of $3.80 per share. The stock currently trades at $88, therefore the dividend yield of the stock is dividend divided by stock price, which equals $3.80 divided by $88, which equals 4.32%. A shareholder that holds 10,000 shares will be compensated with 10,000 times 4.32%, which equals $432. That's cash in the shareholder's pocket. Important things to consider. There are a few things to keep in mind when you're looking to make money from dividend stocks. Some of these things include: 1. Choose quality over quantity. One of the most important considerations for investors when choosing investments is the dividend yield. The higher the yield, the better the return, but the numbers can be deceptive. If the stock's current payout level is not sustainable over the long term, those market-beating dividends can quickly dry up. Selecting an investment that offers more stability may mean sacrificing a certain amount of yield in the short term, but the result may be more favorable, particularly for investors who prefer a buy and hold approach. The income generated by lower risk dividend stocks may be less, but it's likely to be more reliable over time. 2. Stick with established companies. The stock market moves in cycles, and it has a tendency to repeat itself now and then. When choosing dividend investments, there's no better measuring stick than a stock's past performance. Specifically, investors should be targeting those companies that have earned dividend aristocrat status. These are established companies that have increased their dividend payouts to investors consistently over the previous 25 years. Their brands are easily recognizable, and they generate a steady flow of cash with a high likelihood of continuing to do so in the future. 3. Look for growth potential. While newer companies can pay out some impressive dividends, investors shouldn't be jumping on the bandwagon without doing their research. Aside from looking at past and present returns, it's also important to look at the company's future potential to increase its dividend payouts. 4. Be mindful of the payout ratio. A company's dividend payout ratio can reveal how safe the investment is. This ratio tells investors not only how much is being paid out to shareholders, but also how much income the company can retain. If you come across a high-yield dividend stock, but the company is paying out a substantial percentage of its income to investors, that's a sign that you need to tread cautiously. If the company were to see its income stream reduce, the amount of dividends you're receiving would go on the chopping block. Before wrapping up this episode, here are answers to commonly asked questions by both professional and newbie investors. How often are dividends paid? Companies usually pay dividends quarterly, though some pay monthly or semi-annually. A company's board of directors must approve each dividend. The company will then announce when the dividend will be paid, the amount of the dividend, and the ex-dividend date. How do I calculate dividends? Calculating a dividend is generally fairly easy. Simply multiply the dividend paid per share, or DPS, by the number of shares you own. It's also possible to determine the dividend yield, the percentage of your investment that your stock holdings will pay you in dividends, by dividing the DPS by the price per share. How do I know what stocks pay dividends? You can determine which stock paid dividends by researching financial news sites such as Investopedia's Markets Today page. Many stock brokerages offer their customers screening tools that help them find information on dividend-paying stocks. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.